In this chapter, we're going to talk about the function of money, the definition of money supply, and also what backs money supply. The chapter also will introduce you to the banking system, in particular the Federal Reserve, the organization and the function of the Fed will be reviewed, and also the financial crisis of 2007-2008, and how the financial system as a whole has changed as a result of the crisis. And the last word of the chapter will explore the challenges that the regulator have to regulate a large financial institution due to the importance of those institutions to the economy, and also the connectedness of them within the US financial system as a whole. Okay, so the content of the chapter again is the function of money, the component of the money supply, what backs money, and the Federal Reserve and the banking system, the function of the Fed, responsibilities and independence of the Fed. And we'll conclude with the financial crisis of 2007-2008 and what we learned from it. So the function of money. Money is a means of exchange. We use money to buy and sell goods. So we also use money as a unit of account, and we store our value in money. You can store your asset in money, convert it to money, and it will be, it's easier to store it that way. So which function of money is considered the most important depend on the situation. In economy, we focus on money as a medium of exchange and a store of value. We use also money as a unit of account in evaluating GDP. So GDP is a measure in money. So to be able to do the comparison between economies. As a medium of exchange, money allows the economy to function efficiently. You guys recall when we talked about the barter system before the introduction of money? So the barter system have that challenge of the coincidence of need. But before you exchange something with someone else, that person had to want what you have, and you also had to want that person have. So there's that mass of a coincidence of need before you can trade in the barter system. But money make it easier, make it easier to trade. Okay, and as a unit of account, right, money provide a consistent way to evaluate the business activity so that you can compare it from one to the other one. So it makes the comparison easy. And as a store of value, also money allow a person to be able to amass wealth without having to keep the actual product, actual asset, if it's a real asset. So money make it easier to store your wealth and keep it in the long term. And money is the most liquid asset that you have. Money definition. Economy define money in two different ways. The M1 definition of money and M2 definition of money. So you see that the M1 The definition M1 includes currency and checkable deposit. And checkable deposit here includes smaller component, such as travel checks, right? And currency here include coins and paper money. Currency also is referred to as a token money, which means that the face value of the currency is unrelated to its intrinsic value. So what that means is that the face value of the currency itself exceed the actual value of the piece of paper it is printed on, or the metal that is used for the coins. In the past, at one time, the coins were made with a valuable metal, such as gold or silver. And those coins actual value worth than the face value of metal. And the coins. One thing to keep in mind here, currency is held by the Fed, commercial bank, thrift institutions, or excluded from the M1 definition of money, right? Also excluded from money supply are any checkable deposit of the government or Federal Reserve that are held by commercial banks or thrift institution. When I say thrift institution, I refer to a credit union and loan association. Okay. So the M2 definition of money, you can see that the M2 definition of money include the M1 definition plus what we call near monies. Right. And the small denominator time deposit are less than $100,000. So M2 money supply is about 5 times larger than M1 definition of money. And these accounts are, let's see here, are readily available for withdrawal. Okay, so the M2 definition, you have the M1, which is include currency and checkable deposit plus near monies. I will show you the graph, and so you see all the component of M2 definition of money. Near monies here are 7 deposit, including money market deposit, account, small denominator, time deposit, the money market mutual fund, and a small denominator, the time deposit here, as I say, are less than 100,000. So this chart show the distribution of M1 and M2, and help to illustrate the fact that M1 is a smaller fraction of the total supply of money. Okay, so you had the M1 here, currency, 43%, and the rest is checkable deposit. But if you look at the M2, which is about 5 times bigger than M1, right? You have the M1, right, which is only 26%, right? And the rest are mere monies, right? You have the saving deposit. This include a money market deposit account, take the majority of it. You have also the money market mutual fund, a small denominator, time deposit, right? So all this is considered as M2 definition of money supply. So what backs money? Money is guaranteed by our ability, or it's guaranteed by government ability to keep it stable. So the only thing that back money is we all accept the acceptability of money, and money is a legal tender, and also it's a very scarce, the scarcity of money. Think about it, if money was not scarce, we'll lose a value. See the hyperinflation in some area when they inject more money in the economy than what economy actually needed. Okay. Credit cards are not considered as money, right? However, they allow our businesses and individuals to economize the use of money, make it easier to use your money. They are not considered as money. Debit card come from checking account and are considered as money. And at one time, the money supply of a nation was linked to the nation gold supply. I recall what was called the gold standard. And today, most nations move away from the gold standard because managing the supply of money is more sensible than linking to gold or some other commodity whose supply might change arbitrarily. In today's society, people are willing to accept money in exchange for goods or services because of they know that they will be able to exchange the money with other goods and service, right? The acceptability of money. And the US currency is designated as a legal tender by United States government. What that means is that it is deemed a value and a legal mean of paying any debt that was contracted in dollars. And money take a part of its value also from its scarcity. And wanted to note also is money, the supply of money is controlled by a monetary authority to ensure that you remain stable and it remains value or purchasing power. The purchasing power of money is the amount of goods and services a unit of money can buy, right? So if the price level of good or service goes up in the economy, the value of money goes down, and that keep that reciprocal relationship. In the period of a hyperinflation, for instance, when government issue so many money that the purchasing power of each money decline, right? So we experience after war, in general, after war, we experience that challenge of hyperinflation. So in Germany and also in Japan, right? When there's too much money in the economy to the point that it deplete the purchasing power of money. After World War II, that's what we experienced in Germany, and hyperinflation. and also similar thing in Japan as well. So now we're going to focus on the Federal Reserve and the banking system. The historical background of a Federal Reserve system. In the United States, the Federal Reserve served as the monetary authority that controlled the money supply of the country. That was created by Congress with a Federal Reserve Act of 1913. And the aim was to try to prevent the acute problem in the banking system, right? That happened in the early 20th century. The Board of Governors is the central authority, right? And the board have 7 members that are appointed by U.S. president for 14 years term, and the 14 years term are staggered, so that 1 member is replaced every 2 years. The idea is to keep the long-term member, and the long-term provide the board with not just with a continuity, but also with experience, membership, and independence from political pressure. Okay, there are 12 Federal Reserve Bank in the United States. That's what we call a Federal Reserve Bank system, right? In other countries, only 1 Federal Reserve Bank. In the United States, 12, because one cannot cover the entire nation, so there's a 12, and most of the district is rolling to the district. We'll see in the next slide. So think also about the Federal Reserve Bank, right? The 12 Federal Reserve Bank, right, implement the decision of the Board of Governors, right, the 7 members of the Board of Governors, and they are aided by the FOMC, the Federal Open Market Committee. The bank, or what we call the quasi-public bank, what that means is it's a blend of private ownership and public control, right? Each bank is privately owned by private commercial bank in the district, but under the public regulation. Unlike a private institution, the Federal Reserve Bank are not motivated by profit. Rather, they seek to promote the well-being of the economy as a whole. Okay. In emergency situation, the bank become the lender of last resort to the banking system as a whole. After 9/11, for instance, the Fed lent about $45 billion to U.S. commercial bank and thrift to ensure the stability of the banking system. And under normal situation, the Fed lend around 150 million per day to the banking system. So you see that the Federal Reserve Bank had that function, serve as the banker's bank, the way businesses and household bank with the commercial bank with the central bank, right? So they had that function of the banker's bank. So let's see the Federal Reserve system and its relationship with the public. So the Board of Governors here, aided by the FOMC, that control the the 12 Federal Reserve Bank, and the 12 Federal Reserve Bank control the commercial bank and the thrift institution. Under the thrift institution, we have, like I said before, savings, loan association. You have the mutual saving bank and the credit union rolling into the thrift. And the public businesses and household bank with the central bank or the thrift institutions. Okay. So the FOMC here, the Federal Open Market Committee, is a group of 12 individuals, including the 7 members of the board, right? The president of the New York Federal Reserve Bank, and 4 other president of the Federal Reserve Bank on a 1-year rotating term. They meet regularly to direct the purchase or sales of government security. And the purpose of the activity, selling or buying a government security, is to control the nation money supply and influence interest rate. So if you look at the map of the United States, you'll see that there's a heavy concentration of the Federal Reserve Bank in the east, northeast, if you compare it to Midwest or the West, right? And this reflect the population densities at the time that the Federal Reserve System was set up in 1930s. And recall that at that time, the West was largely unsettled. So there wasn't a big need of a bank compared to the East. The most common thrift institutions are credit union. In addition to being a subject to the monetary control of the Fed, bank and thrift are subject to regulation by various agencies, such as the Federal Deposit Insurance Corporation, right, that insure banks, and the National Credit Union Association. So both bank and thrift are required to keep a certain percentage of their checkable deposit as a reserve. So this global perspective bar chart represents the 12 largest financial institutions in the world as year 2018, with the asset. Yet all the assets were converted into US dollars to be able to make the comparison. Federal Reserve function. Note that contrary to public opinion, Federal Reserve or the Fed does not set interest rate that most people pay. Right? It set the discount rate that is charged to bank for short-term loan. Right? It charges the discount rate. It doesn't set the interest rate that most of us spend. Right? And set a discount rate, and then the discount rate contribute to the rate that bank and thrift charge consumer on the loan. The Fed also have the ability to issue the Federal Reserve note, a paper currency used in the US monetary system. They do not print money. They do not print money. And printing money is a tax performed by the US Mint. The Fed also facilitate the movement of money by providing the bank system with a mean of a collection on check. The Fed also act as a fiscal agent for federal government by collecting money owed to a government from taxes and assisting with government spending. The Fed make periodic examination to assess bank profitability. After the financial crisis of 2007-2008, Congress increased the Fed supervisory power, so the Fed can have more power to supervise the financial institution and make sure that they are complying with the standard in place. The Fed independence. So there are two types of federal agency: independent agency and executive agency. Right, executive agencies fall directly under the control of the president, and therefore they may be prone to political pressure. Independent agency do not report directly to the executive branch, right, of the government. As an independent agency, Fed tend to avoid political pressure that Congress and executive branch face, right? That sometimes can result or may result in making a wrong decision and push the economy through inflationary fiscal policy. So when Congress established the Fed, they make sure that they give the Fed that independency that protect the Fed from political pressure, so they can make objective decision and take action to increase interest rate or decreasing interest rate, whatever is in the interest of the nation. So the financial crisis of 2007, 2008, and as you all know, the cause of this crisis are still being debated today, but most authorities feel that the mortgage default crisis was the key component, right? Most banks and regulators had a mistakenly believed that the innovation known as a mortgage-backed security has eliminated most of the bank exposure to mortgage default. Right, mortgage security are what? Mortgage security are the security backed by mortgage payment. It was thought that this was a smart business decision, as these mortgage-backed security transfer any future default risk on those mortgage to buyer of the bond. But instead of the bank, unfortunately, the bank took the money that they receive from the bond, the selling of the bond, and loan it to the other investor, to the point that once the default started, it was like a house of cards that affected every area of the financial system. Securitization. The system probably could have survived the failure of one component of the system, but unfortunately, all three elements collapsed at once. Interest rate increased on an adjustable mortgage at the same time that the house prices fell. So consumer, so say borrower, began to fall behind the payment of their mortgage, right? As the economy slow and the payment also increase. All those two things together, all those factors precipitate the collapse of the financial system. And during the crisis, or to mitigate the effect of the financial crisis, Congress passed a certain measure to be able to push the economy out of the recession. And one of the acts passed by Congress is the Trouble Act Relief Program, right? That tried to save the financial institution that were affected by the crisis. And by spending allocate about 700 billion to make an emergency loan. However, the process of the government bailing out a business is subject to too much debate, right? Is it the concept of moral hazard? Right, the problem for moral hazard was created when the federal government bail out those firms that make originally bad investment decision. So the idea is by bailing them out, what message it was sent to them, right? Do some firms make a risky investment knowing that they are too big to fail, and government will step to save them? So those are the debate today within the economic community, right, to see if the act to bail them out was a good act. The single largest policy response to the crisis was the passage of the Wall Street Reform and Consumer Protection Act. The act was designed to get the Federal Reserve a broader authority to regulate financial institutions with the hope of preventing the reoccurrence of such a crisis. But critics argue that protection already existed, right, but not being used properly. One thing also that was pointed out is that government policy on issues such as home ownership, right, to promote home ownership contribute to the crisis also, because back then government promote the policy to reduce mortgage interest rate in order to facilitate home ownership. The last word of the chapter, I talk about the concept of too big to fail, too big to fail. So the Fed has acted as the lender of a last resort for both solvent and insolvent firm, and that increased the moral hazard problem. So during the financial crisis, well, the Fed made a decision to make a loan, not only to the firm that was solvent but a liquid, but also to firm that were insolvent and a liquid. And the idea was that if the insolvent firm went under, they will likely take the solvent firm with them. So by doing so, the question is, did the Fed increase the moral hazard problem going forward? In that firm or financial institution will be more willing to engage in risky behavior because of the idea of too big to fail, and the economy cannot let them fail.